Amy, and welcome everyone to, I think it's our fourth or fifth webinar in the PPP program. I think we're trying to stagger them, waiting for enough information to pile up where we feel like we can deliver some value to you. And really in the last month since our last webinar, there's been a whole bunch of additional information that has come out on the forgiveness stage. And so we thought we'd tailor today's presentation to that. So I'm Adam Sweet. I'm a principal. I'm part of Eide Bailey's National Tax Office in Spokane, Washington, also part of our SBA PPP working group. And I am joined by Michael Holdren. Michael, if you want to introduce yourself.
Sure, I'm a senior manager in our Des Moines, Iowa office, and I serve primarily our financial institutions clients throughout the state of Iowa and beyond.
Perfect. So just we highlight this, but I continue to highlight it, that as we have maybe an article we put out every week or two, we have other short videos that we put out every week on the PPP program. You can find all of that if you go to eidebailey.com/PPP. Really, anytime there's a notable development in the PPP world, we try to have something out there. We email it to clients, but if you don't get it, or if you're looking for a new copy of it, I'd really encourage you to go to our landing page. So today's agenda, first, we're going to talk about what do we know at this point in terms of compensation limits for owners and non-owners. And when I say compensation limits, this is eligible expenditures. Some discussion of the new FTE safe harbor. We discussed this on our last webinar, but there's been some further developments with this FTE safe harbor, and it seems to be the one that's generating the most client attention. So maybe discuss that safe harbor as well as some nuances. The third topic, probably the majority of our time and what most clients are interested in, is the notion or the concept of applying early for forgiveness. So this would be if you're using the 24-week covered period, can you apply early? And if you do, what are the consequences? And then we have a kind of a series of miscellaneous potpourri topics towards the end if we have enough time. And as always, we probably won't have time to get to the questions that are posited to us. If we have time at the end, we'll try to get to them. But otherwise, as Amy said, I just encourage everyone to follow up with their local Eide Bailey professional. So the compensation limitation is really broken down into two buckets. Think about it as owners and non-owners. And I won't define non-owners, but I'll define owners on the next slide. And so you can think of non-owners as everyone else but that. But for non-owners, the maximum compensation that can be paid, compensation is their actual salary. That doesn't include their benefits and so forth on top, but the actual salary, for the 8-week covered period, it's $15,385. For the 24-week period, it's $46,154. And how do you get to those amounts? Well, the maximum compensation that you can pay at an annualized rate is $100,000. So 8-week is 8/52 times $100,000. 24 weeks is 24/52 times $100,000. That's how do you get to those numbers. And I just remind everyone, this is just the salary component. So benefits can be layered on top. Benefits would be healthcare, retirement, so forth. Those can be put on top of this number. And then also, I've had this question a few times. Does this mean that an employer can't pay more than this? The answer is no. You're free to pay however much you want to an employee. These amounts are just the capped amounts that qualify for as an eligible expenditure for forgiveness. So you could pay someone, if in the 8-week covered period, you can pay them 30 grand. Nothing stands in the way of that. It's just only the first 15,385 would qualify as a forgivable expenditure. So for owners, there's a separate set of rules. And who are owners? Well, owners are defined by the SBA to be owner employees. Owner employees, they don't explicitly state this, but I think owner employees are S corporation shareholders who are also employees of the S corporation. So they're owners of the entity and they're also employees. Owners also include self-employed individuals and general partners. And for that last point in general partners, I think general partners is typically a term of art. And in the tax world, that doesn't mean that it has to be a general partnership. It could certainly be an LLC taxed as a partnership. And if you have partners that are materially participating in the business, I think they could be considered general partners. So don't get too hung up on the term general partners. But for these people, the maximum compensation that can be included as an eligible expenditure is $20,833 for borrowers using a 24-week covered period, or the equivalent amount, the 2.5-month equivalent of their compensation in 2019, whichever is lower. So it's the lower of 20,833 or the equivalent 2.5-month period in 2019. For the 8-week covered period, it's just the mirror of that. It's the lesser of $15,385 or the equivalent 8-week period in 2019, whichever is lower. So can't exceed that, but could be limited by that. I was just talking to Michael this morning. We're not quite sure exactly what it means, the equivalent period. I don't know whether that means if your 8-week period is April 15th to the end of June. I don't know whether that means the equivalent period is April 15th to the end of June 2019, or whether it's somehow you have to average it out for the whole of 2019. Not quite sure on that. So to be safe, you'd probably average it out over the whole of 2019 and bring it back to 2.5 months, but a little bit ambiguous there. And why they have that there is they're trying to prevent people from paying special bonuses to owners to generate extra forgiveness amounts. So that's why they have the limitation in there. You can pay bonuses to non-employees because there's no limitation there, but for owners, there is the limitation. So the other side of it is included in the definition of payroll costs are employee benefits paid by the employer. And for non-owner employees, you can include the full amount, the employer share for health insurance, retirement, state and local taxes, and so forth can all be included in there. However, there are special rules for owners here as well. And basically for all owners, so for S corporation shareholders, self-employed individuals, general partners, you cannot add employer contributions for health insurance because according to the SBA, according to the government, such payments are already included in their compensation. So the example here, it would be in a W-2 issued to an S corporation shareholder. The health insurance is already included in their W-2. So according to the SBA, it would somehow be double counting, I suppose. You can quibble with that. I mean, there's certainly inconsistencies there, and is it always included in their compensation? Maybe not, but that's what the government said. For retirement plans, it's a similar rule, but it only applies to self-employed individuals or general partners. And what it says is retirement plan contributions made on behalf of an employer are not added to payroll costs because, again, such payments are quote unquote already included in the compensation. But there is not that same rule for owner employees of an S corporation. So apparently retirement plan contributions made by an S corporation on behalf of an S corporation owner employee, those do qualify as eligible payroll expenses. So that's really the only exception. If you wanted to, the sum takeaway is health insurance, retirement contributions generally don't qualify as additional payroll expenses for owner employees. The only exception is retirement plan contributions on behalf of S corporation owner employees do qualify. Maybe Michael, Amy, I'll turn it over to Michael, and Michael can walk us through a quick example.
So, yeah, thanks, Adam. So when looking at the differences that Adam just mentioned, we have an example here to highlight how the treatment of each of those different employees would look. So we're assuming the borrower's elected the 24-week covered period, and the overall payroll expenses incurred during that covered period are as follows. So first, we have a non-owner employee. We had $45,000 of compensation, and then an additional $15,000 of benefit payments, $10,000 for health insurance and $5,000 for retirement. Now we have an owner employee, employee number one, who had overall compensation of $55,000. And as Adam mentioned, remember, we need to keep in mind the 2019 equivalent period. And during that time, they earned $40,000. And this employee then earned 10,000 of health insurance benefits and 7,500 of retirement. And then also employee owner number 2, 20,000 of compensation, 15 for the equivalent 2019 period. And again, 10,000 for insurance and 5,000 for retirement. So if we unpack that and take a look at what this might look like from an overall eligible payroll cost standpoint, for the non-owner employee, because the 45,000 is less than the maximum 46,154 that Adam mentioned previously, we can include the entire 45,000. Additionally, for non-owner employees, we can include the health insurance and retirement benefits. So in that case, all 60,000 of costs are eligible payroll expenses. For owner employee number 1, as Adam mentioned, the rules are different. So they had 55,000 of total compensation and 40,000 for the equivalent 2019 period. However, the maximum overall compensation allowed for the 24-week covered period is the 20,833. So we're capped at that amount. They aren't allowed to include the health insurance, as Adam also mentioned, but we do get to include the retirement benefits. So the total eligible payroll cost for owner employee number 1 is 28,333. Slightly different for employee owner number 2, however, we would be able to include the full 20,000 of compensation because that's below the maximum for the 24-week period. However, again, we have got to look at that applicable equivalent period for 2019 and take the lower of. So in this case, we're capped at the 15,000. Even though that 20,000 is below the maximum allowable compensation. So we have to take the 15,000. Again, the health insurance is excluded, but we are able to add the 5,000 for retirement costs. So total eligible payroll costs for this individual owner employee would be 20,000. And Amy, I'm going to hand it back to Adam after this polling question. So we're at our first polling question. There are special limitations on owner compensation for PPP eligible expenditure purposes. True or false?
All right, so for everyone who joined us just a little bit later, polling questions are for CPE credit. The polling question is now open. We're going to leave this open. Feel free to answer while Adam continues on.
And quickly, I saw a couple questions come in on why are there special rules for owner employees? I mean, the point in the questions, and it's a good one, is that this is a true expense of the employer. It's cash out of pocket. So why are there limitations? I think what the SBA is trying to do is set guardrails and make sure that borrowers don't funnel too much money to owners. You know, too much is defined by the SBA, but SBA is trying to make sure that the majority of the money is going to non-owner employees. And I guess that's a policy decision the SBA has made. You can definitely argue with it, some of it, but it is what it is, and they've been pretty clear with that, and they've been pretty consistent with that, they being the government. So the next item I wanted to talk a little bit about was, we talked about this a month ago. There's a new FTE safe harbor that was introduced by Congress and signed into law by the president 5-6 weeks ago by the Paycheck Protection Program Flexibility Act. And just as a very quick refresher, you have to maintain your employee count during your covered period. Your employee count is your full-time equivalency. If you've cut your FTEs during the covered period, it can proportionally reduce your amount of forgiveness. So if you're at 90% of your FTE count as compared to a certain reference period, you can suffer a 10% haircut to your forgiveness. But like everything Congress does, there's the rule and then there's the exceptions. And this is one of those exceptions where even if you've had an FTE reduction, you can avoid a forgiveness haircut. And a couple of key points here. The first thing is that, and we're going to talk about this here and over the next few slides, but during the period beginning on February 15th and ending on December 31st, the amount of forgiveness, you can calculate your forgiveness and ignore any cuts to FTE if, and I'm going to focus on paragraph B here, capital B, if the employer is able to document an inability to return to the same level of business activity as such businesses while operating at before February 15, 2020, that's before the COVID-19 emergency due to compliance with federal guidelines, federal health and safety guidelines. So let's unpack that a little bit. First of all, we have an IFR interim final rule from the SBA that took a very generous interpretation of this. And specifically here in the second bullet point, that they said that complying with, although the statute talks about having to comply with federal directives, the SBA interpreted it indirectly to also include having to comply with state and local directives, because state and local directives often follow the lead of federal directives. So that basically, if your business has been impacted, not by federal directives, but by state directives, you can still potentially rely upon this FTE safe harbor. So interesting nuance there. I think that's the right policy decision from the SBA, but also a borrower friendly. Also notice that in this first paragraph that you need to document how you've been affected by this. So for instance, in this IFR, they talk about including copies of the applicable requirements or guidance and your relevant financial records to demonstrate how this complying with the state and local or federal requirements, how this impacted you. So that will be interesting too. But the question we get from clients is, how broad is this exemption? Because I think most borrowers are going to be able to say they've been impacted from federal guidelines or state and local guidelines. I mean, almost every state has had a version of a shutdown. You know, I'm in Spokane, we had a shutdown for almost 8 weeks. We're in what they call a phase 2, which is kind of a partial shutdown. I would imagine most of the country is now or has been in something similar. So it seems like you're going to be able to, many businesses will be able to meet that requirement. Also, it's interesting though, it doesn't state how much your business has to be affected by. It just states that you're not able to return to the same level of business activity that you were operating at before February 15th, 2020. So the questions we get from clients are, well, what about a 10% reduction? What if I'm operating at 90% capacity? Technically, and your 10% reduction is due to compliance with COVID. Let's say you're a restaurant or you have mandatory spacing and somehow that's reduced your business, but only by 10%. Is that enough? I think technically, yes. The answer is that is enough because there is no numerical or objective standard there. It just says not at the same level you were at before February 15th, 2020. I don't know whether we'll get further guidance from the SBA on this. There's an example we'll cover here in a second, but it doesn't seem to, all it seems to require is that you are not able to operate at the same level you were at before February 15th, 2020. And then here's an example that is again from the IFR. IFR is the interim final rule. Borrower sells beauty products both online and in a physical location. Physical location has been shut down due to compliance with local government orders. And because the business was reduced as compared to the period February 15th due to complying with the COVID requirements, the borrower can meet the safe harbor if it maintains records demonstrating the reduction in business activity and also records relating to the local government shutdown orders. Now, again, there's no mention, there's no numerical or quantitative numbers here. There's nothing here that they were reduced by 50%, nothing that they're reduced by 80%. So conceivably, this could be they were reduced by 20% or 10%, and potentially they would have satisfied this safe harbor. I think this will be a very popular for people facing an FTE reduction. There are a number of safe harbors or exceptions that you can rely upon. You know, one of them is just if you restore your FTE cuts by the end of your covered period. But if you're not able to do that, if you're not able to restore your FTE numbers, I think this particular safe harbor exception is going to be very popular for a lot of people. I think potentially a lot of borrowers will be able to rely upon this. Now, pending, the only question would be, will the SBA surprise us with additional FAQs that somehow flesh this out more and maybe put some sort of guidelines to this or bumpers to this to show us where you're inside this rule and where you're outside the bounds on it. The last point here, and this is another interesting one, if you go back to the very first slide on the safe harbor, it talks about during the period beginning on February 15th, 2020, and ending on December 31st, 2020, that's where you measure your business activity. The issue here is, well, what if you apply for forgiveness before December 31st? What if you have an 8-week covered period and you want to apply for forgiveness in the end of July or August? Or what if you have a 24-week covered period and you apply before the end of your covered period, or you apply before December 31st? Can you still rely upon this FTE exception? I think the answer is we don't know. Because technically right now, it seems to say somehow you'd have to wait until the end to demonstrate the reduction in business activity because the marker is December 31st, 2020. So and this is going to be a continuing theme here. Michael will have the next section talking about potentially applying for forgiveness early and all of these unknowns that go along with it. You can add this to the mix. We just don't quite know if you're relying upon this particular exception or safe harbor. Are you forced to wait until December 31st, 2020? Hopefully not, but potentially yes. It brings us to our second polling question. You expect to face a PPP loan forgiveness reduction due to your FTE full-time equivalency headcount. True or false?
All right, that poll is now open. We will leave that open while our presenters continue on.
I'll turn it over to Michael here, Amy.
Mike, you muted.
Yeah, you're on mute, Mike.
I sure was. Sorry about that. So we're going to shift gears a little bit and start talking about applying for early loan forgiveness. So borrowers who received loans before June 5th have the option to elect the 8 or 24-week covered period. Now, the government stated that a borrower using the 24-week covered period can apply for forgiveness before the end of that covered period. So the question might be, well, why would anybody choose anything other than the 24-week covered period, given that you can apply for forgiveness at any time, week 10, 15, 20? Well, I think the clear answer here is you would elect the 24-week period if during the 8-week period you did not have enough eligible forgivable expenses incurred that would lead to full forgiveness. So if under the 8-week period you didn't have enough time, whether it's because you reduced, maybe you weren't at full capacity, you lowered some salaries or some FTEs and you didn't have enough time to incur those expenses, the 24-week covered period will be most likely the appropriate option for you to select. Now, if we take a look at the 8-week covered period, salary and FTE reductions are measured at the end of that covered period. With the changes in the Flexibility Act, June 30th is essentially no longer a relevant date. So if the 8-week covered period were to end on June 15th and the borrower were to apply for forgiveness on August 5th, the date for looking at FTE and salary reduction information is going to be June 15th. That's the date that you're going to want to make sure that you make those FTE and salary calculations. So the question might be, well, why would a borrower wait until August 1st to apply? Well, currently, the SBA has not released information and further guidance for banks to allow them to process and submit applications. So most banks aren't even accepting applications at this point. So that's going to lead to a future date for applying for forgiveness, even if under the 8-week period you qualify and your covered period ends prior to submission of the application.
Yeah, and I don't even think, Michael, I don't think we've heard of even a single bank. I mean, this is probably a bold statement to make, but I don't think we've heard of a single bank yet that is accepting forgiveness applications.
No, I have not. And I think if you were to visit most of their websites, there would be some type of communication, or if you've reached out to your lender, you've probably heard the same thing, that they'll reach out to you and let you know when they will start collecting the forgiveness application. So at this point, we're kind of in a waiting pattern until they get further guidance and the submission process is made available to them. Now switching over to the 24-week covered period. Now, as we mentioned, you can apply before the end of the covered period, and salary and FTE calculations for the 24-week covered period, as described in the application, are tested at the time of the forgiveness application submission. Now, according to the interim final rule, a borrower may submit a loan forgiveness application at any time on or before the maturity date of the loan, and this is important, including before the end of the covered period. So here we have the guidance that tells us we can submit early if the borrower has used all loan proceeds for which the borrower is requesting forgiveness. Now, however, if a borrower applies for forgiveness before the end of the covered period and has reduced any employee salaries or wages in excess of 25%, the borrower has to account for those reductions for the full 8 or 24-week covered period. That's a little bit of a lot to digest, so let's unpack that a little bit with an example.
And I just say one thing on that previous slide, I put in there, apparently for FTE, we're not 100% sure that how that works for FTE. For salary, the government has told us the date of application is when you test for salary. They didn't say directly for FTEs. We're assuming, I mean, it would make sense that it's got to be at the same time, but we don't. And this will come up here in some later slides, but we're still, it's a little unclear in that particular point.
Sure. Yep. So an example from the interim final rule to discuss that 24-week salary reduction piece and having to submit the full amount for the salary reduction. So a borrower elects the 24-week covered period. They're paying a full-time employee weekly $1,000, and that's reduced $300 to $700 during the covered period. But they are still working on a full-time basis. In this case, that $300, that reduction, the first $250 or 25% is exempted from the forgiveness reduction. But when the application is submitted, the borrower will list $1,200 as the salary or hourly wage reduction for that employee. And how you get to that is it's the difference between the $300 reduction and the $250 exemption. So you have a $50 weekly reduction multiplied by the 24 weeks. So even if the borrower applies early before the end of the 24-week covered period, they still have to multiply out that $50 weekly reduction for the 24 weeks or the $1,200 as noted there. Now, as Adam mentioned, the interim final rule and examples do not specifically address the FTE count reductions, but it does appear that those FTE counts would be tested at the time of the application submission as well.
Yeah, and so it's not one other point. I saw this question come up. It's not, you are still forced, it's either an 8-week or a 24-week covered period. There's no such thing as a 15-week covered period. Now you can select the 24-week covered period and apply early, but you're still stuck with the 24-week covered period. So one example of that is your salary. If you've cut your salary, you have to prorate that and account for that over the full 24-week covered period. So the uncertainty for FTE count is, if your FTE count is at 100% of data application, it's week 15, you still have to maintain your FTE count through the whole covered period, because you can't just make it a 15-week covered period. The government was clear on that. So that's the point. We're not certain on that point now. Hopefully the answer is you're done when you submit your forgiveness application, but it's certainly a little bit unclear.
That's right. So here's a kind of a simple example that we've been hearing more and more about in terms of applying for forgiveness early and not being able to submit an application, essentially when the application is complete. So We have a borrower using the 24-week covered period, and as of July 20th, they've qualified for full forgiveness and they have enough eligible expenditures. The borrower hasn't reduced any salaries or headcount as of July 20th. However, they're not able to submit their application for forgiveness until August 10th. So apparently the borrower would need to maintain employee salaries and headcount through August 10th, unless, of course, the borrower is able to, on their application, utilize one of the exceptions under the safe harbors. So the question that kind of remains outstanding is the application date and the submission date one and the same. Can a borrower complete the application, sign the certification with all the necessary documentation, have that complete, and then submit it to the bank at a later date? Is the submission date the same as the application date? Can it, you know, are those two dates the same, or can you fill out and complete the certification as of a specific date and submit later? Right now, we don't know, but apparently it seems to think that, you know, until you submit it, maybe the clock hasn't started, or at least it doesn't stop. Maybe it would be a better way to put it for the forgiveness application and those calculations.
And it would sure help. I mean, who knows if we'll get it, but it would sure help to have some Q&A from the government, maybe even using this type of simple fact pattern here of what is the answer, because I think no one quite knows, and I'm sure that banks don't even know what the answer is. I did see also in the comments, Michael, a couple people mentioned that there's a couple of banks. I know one's even a large Utah bank. I don't know if I can name the bank, not that we want to give any, that are accepting forgiveness applications right now. So that's good news. On the other end of the spectrum, there's a very large national bank that has said that they won't process until the middle of August. So maybe there's a full range there, maybe depending on who your lender is.
So that brings us to our third polling question. Borrowers can apply early for PPP loan forgiveness, true or false?
All right, that third poll is now open. Please feel free to answer that while our presenters continue on.
And I'm going to hand it back over to Adam.
Thank you. And I see in the questions, there are certainly other, we're not going to cover it today because it exceeds our scope. There are certainly other FTE exceptions you can rely upon. There are certainly other, if you've cut salary, there were other exceptions there. I only focused on that one FTE exception because it generated a lot of questions, but there are other exceptions you can look to. So all hope is not lost. If you can't satisfy the FTE exception I highlighted, and you've had FTE reductions, there are certainly other things you can look at there. And we're not, by excluding those today, we're not saying they're not relevant. We're just saying we just don't have enough time today to cover them. You know, the other exception really quickly for both salary and FTE is if you restore those amounts, basically, by the time if you've had a cut to FTE or a cut to salary and you restore those amounts, basically by the end of your 8-week covered period or by the time you apply for forgiveness, that's the other exception, probably very common exception that we see, or that we would, that's probably our first piece of advice we give to someone if they've cut FTE or salary is, can you restore it? And if they can't, well, then you're looking to some others, some of the other exceptions.
And I think that's, you know, a common question we're getting with the application date and, you know, restoration of headcount, looking for some certainty that they do qualify, and that is the cutoff in case maybe there's another, you know, shutdown in your local economy and you need to reduce headcount after the end of your application period. What is the cutoff for the FTE headcount? And right now it appears that it's the application date, but as Adam mentioned, there's some ambiguity as to the certainty surrounding that.
And so, and if you were, so borrowers who received a loan before June 5th can choose either the 8-week or the 24-week covered period. So if you're one of those borrowers and you were debating 8-week versus 24-week covered period, one benefit of the 8-week covered period is it gives you certainty, because that covered period is probably over now for you, or close to over. and you know that it's your FTE count and your salary at that date is what you'll be measured against. So if you have enough expenditures, or if you're close, there's a level of certainty with the 8-week covered period versus the 24-week covered period. We just don't know, because yes, you can apply early, but it's still a 24-week covered period. And what does that mean for FTE and salary maintenance? So just changing gears, this has been a topic floating out in the cloud or the ecosphere, or I've read about it and heard about it really for the last 5 or 6 weeks, and it came out really when the first forgiveness application was released. I was really hoping that there'd be guidance from the SBA in this point. Part of the reason why I didn't talk about it previously was I was skeptical of what the answer is. There's an answer people are pushing, and I was skeptical of it. But the SBA's had some time now to clarify or fix, and they haven't done it. So maybe really my skepticism was misplaced. And where this comes about is if you look at the current forgiveness application, what it lets you do is tally your expenditures, your eligible expenditures, your payroll, which is 60%, and then your eligible non-payroll expenses, which can be up to 40% of your expenditures. But you add up your total expenditures. And those expenditures can actually exceed your loan amount. My next slide will show how this works. But particularly in the 24-week covered period, we're going to see a lot of this, because if you remember, the original loan is based on 2.5 months of 2019 payroll, and a 24-week covered period is going to have almost 6 months of payroll, so almost 2.5 times as much payroll as it was included in your loan. Plus, you can layer on an additional 40% of eligible non-payroll costs. They're going to be probably most borrowers with a 24-week covered period will have eligible expenditures that exceed the loan. Why does this matter? Well, the FTE reduction and then the salary reduction, those are both the two factors that can reduce forgiveness. They go against your expenditure total. They don't go against necessarily just your loan amount. And this can result for many borrowers in really reducing the potency of the FTE and the salary reductions. This is directly from the forgiveness application. So if you see lines 1 through 4 would be your payroll costs, and then your non-payroll costs. You add those up, and then you factor in your salary and your FTE reduction. So it would seem to say you can have an amount that's greater than your loan amount, then you add in your FTE and salary reduction, and even if you have a cut there, you may end up with an amount of forgiveness that exceeds the loan, resulting in full forgiveness. So just a example I put together here, if a borrower used a 24-week covered period and they have a $125,000 PPP loan because their payroll was 50 grand a month in 19, so 2.5 months of that's 125 grand. During their covered period, the borrower maintains their hourly wages, so no salary reduction, but they cut their FTE count by 30%. So there were 30% reduction to FTE, and their average payroll is $40,000 a month because they've reduced the FTE count. And I'm doing rough numbers here, so don't pencil to paper if I'm off on my math. It's okay for this particular example because the math isn't so important. But let's just say the borrower has roughly $200,000 of eligible payroll expenses, plus another $100,000 of eligible non-payroll expenses, so $300,000 of eligible expenditures during the 24-week covered period. Even if the borrower doesn't satisfy any of the FTE safe harbors that we've talked about or exceptions, so even if they're subject to the FTE reduction, the 30% haircut would go against $300,000, resulting in $210,000 of eligible forgiveness. And if we look back up, my loan, the borrower's loan was $125,000. So it would appear still to result in full forgiveness, even though I've cut my FTEs by 30%. So the question is, and it's still a question in my mind, is this really what the SBA intends? If those who argue yes would say, well, we've had 2 iterations now of the forgiveness application. We had the initial one that came out 4 or 5 weeks ago. We have the new application that came out reflecting the 24-week covered period, along with the EZ application. And they have not changed the structure of the application. In other words, it still looks just like this. So you would glean from that maybe that there's intent there, that they're aware of this. They haven't changed it, they haven't discussed it. So in fact, you are allowed to tally expenditures that exceed your loan amount. I guess the only thing that could really throw cold water on this would be if the SBA comes out tomorrow, I guess tomorrow, Saturday, comes out next week and says that eligible expenditures must be derived from the loan amount, meaning that total expenditures cannot exceed the actual loan amount. I'm frankly a little surprised they haven't said this already, but maybe again, maybe I'm being too conservative here, that maybe the SBA is fully aware of all of this and they've made a policy decision that you can have expenditures exceeding the loan amount. I guess why I'm skeptical is that it just renders the FTE and salary reductions moot. I mean, you could almost have a 50% FTE reduction and it may not impact your amount of forgiveness there.
You know, one thing kind of, I mean, similar to this topic, I've gotten a few questions from clients on, you know, in this case, there was $200,000 of payroll costs and $125,000 loan. Can a borrower just submit a payroll report because they had enough payroll costs to cover the eligible expenses or to qualify for full loan forgiveness? And I think that makes sense. I guess I would encourage you to reach out to your lender because the application does have requirements for documentation to be submitted, but it does make sense to take that kind of expedient given that you wouldn't have to get all of the non-payroll documentation and receipts and all of that if you could just submit one payroll register that covers the entire loan amount. But the application does have documentation requirements, so I would encourage you to reach out to your lender and discuss that in terms of filing for forgiveness.
And one reason I may be too conservative, if there was someone, there's other commentators out there that are more bullish on this, meaning that it's intentional, the Congress was intentional and the SBA is intentional. And the reason why they would say is, well, they're just trying to make it easy for forgiveness. They want them a maximum number of people to achieve forgiveness. And so that's, I think if you had someone else on here that wanted to argue with me, that's the point they would make. And I would certainly say that's true. I think there's no doubt about that. It just would, my counter would be that, well, then what's the purpose of the FTE and salary reductions? Because it doesn't seem, they would just seem not to matter, to be rendered moot for many borrowers. I mean, to Michael's point, you'll have just enough payroll for the 24 weeks to just submit that and ignore potentially any salary or FTE reductions. So we don't know, so we'll stay tuned for that particular one. We've hit this point a few times and I continue to get questions on it and people asking, and so I thought it would just bear repeating. The current forgiveness application and the instructions, when they talk about eligible expenditures, they talk about eligible expenditures that are paid and eligible expenditures that are incurred. It doesn't say they must be paid and incurred. So it's almost the best of both worlds. It almost is a cash basis test, also an incurred test. So for instance, in payroll, we get this question a lot. If you pay a payroll the day after your covered period begins, and I should have had an example here, but let's just say your covered period, your loan funded April 30th, and your covered period begins May 1st, and you pay payroll May 1st, but those costs were incurred for the previous 2 weeks before the covered period. My interpretation of that, and Michael, I'm, I guess, interested in your thoughts, is absolutely that qualifies as an eligible expense. It was paid during the covered period. I know it was incurred before, but it's just paid. And that, to me, that's end of story.
I agree. And I think in the 8-week covered period, that is potentially the saving grace for some to kind of hit that threshold for the 8-week period, because they almost potentially could get an additional payroll to help kind of reach that full forgiveness level.
And then on the other side of it, the rule is very clear that if you have a payroll, if you make a payroll payment after your covered period closes, So let's just say your covered period closes June 1st and you make a payroll payment on June 5th, but 80% of that payroll is for payroll that was incurred during your covered period. The SBA is very clear that the incurred costs count as eligible payroll expenditures, even though they were paid outside of your covered period. So to me, this is crystal clear. I only put it up here because I still get questions from clients. They almost they doubt it because it seems too good to be true, that you can get the best of both the cash basis paid, but also the incurred. And my answer is, I think it's a rule of practicality, one, because you're going to submit payroll records and the SBA doesn't want the lender having to suss through those and figure out, well, you paid at this date, but it was incurred previously. It's probably too much work. So really all they're going to want to look to see is a payroll that was paid during your covered period. And then they gave you kind of the added bonus of at the end, even if it was paid after, you can get the incurred portion of it there. But it also, this paid and or incurred language also pops up for eligible non-payroll costs. And again, it appears to be both a cash basis test or an accrual or incurred test. And it's not both. So this is the quote directly here. This is from the IFR interim final rule. A non-payroll cost is eligible for forgiveness if it was one, paid during the covered period, paid as cash, or incurred during the covered period and paid after on the next regular billing date, even if it's after the covered period. So similar to the payroll, you get the best of both worlds. The questions we get are, okay, what about prepayment? What about late payments? What if I'm paying rent? And the only guidance we have is the current forgiveness application states that mortgage principal and interest cannot be prepaid. So you can't pay 3 months of or 4 months of mortgage or interest. It's only during your covered period. But there's a bullet right below that for rent, lease, and utility payments, and there's no reference there to those not being able to be prepaid. So was that intentional? I don't know. Do we give the SBA too much credit? Do we read too much into it? It seems intentional. Why would they state that? They could have easily stated that all non-payroll costs can't be prepaid. That would have been an easy thing for the SBA to do. That would have been end of story. But instead what they said was only that mortgage principal and interest cannot be prepaid. But rent and lease payments, you're just subject to the same paid or incurred. So what are the outer limits of that? I don't know. I don't think I'd want to be the person with 12 months of rent asking for forgiveness, but I don't know. What about late rent? What about late, Michael, what about a late rent payment? What if a client comes and said, our covered period started May 1st. We've been late on March and April. Can I just pay that all during the covered period?
Seems to be that the cash basis would allow for it. And I think the intention of the program, it got watered down a little bit from the 75 to the 60%. It almost seems to go to say the SBA, as long as you're meeting that payroll threshold, that limitation, they're almost not as concerned about the non-payroll costs. We're helping support your operating expenses, but you need to hit the payroll threshold, and then maybe we're just giving more leniency on the operating cost side of things.
Yeah, I think that's right. And I think that they're deferring. I mean, if they have a choice between trying to create a rule that produces less forgiveness or more forgiveness, I think they're erring on the side of producing more forgiveness, because I think their marching orders from Congress were to the SBA's marching orders from Congress was, we're trying to help people. We're not trying to slap them on the wrist. We're not trying to penalize them. So if they're making best efforts, to Michael's point, if they meet in the 60% that threshold for payroll, then we're not going to have a bunch of strict rules for paid versus paid and incurred on non-payroll expenses. The easy application, this may be helpful for quite a few borrowers out there. There are no size limitations. I've had this question come up. Is it only for people of a certain size? No, you could have a loan for $5 million. And potentially you could use the easy application. The only trick is that you have to meet one of three conditions. Why would you want to use the easy application? Well, you completely sidestep all of the FTE calculations, salary reduction calculations. All you do in the easy is calculate total expenses, and then you end up with a forgiveness amount. So it's a much easier calculation. But to meet the requirements for it, you basically have to certify that you wouldn't be subject to the FTE reduction or salary reduction penalties anyways. Because you have to meet one of these three things, and it's either you're self-employed with no employees, which means that you wouldn't be subject, you don't have any employees, and you don't have any salary cuts to take into account, FTE cuts to take into account, or you had cuts and you restored them, or you've had cuts and you can rely upon one of the exceptions or safe harbors. So if you can meet one of those three conditions, you can check that box and you can use the EZ application. So it's nice for those people that qualify. It may force you, in a way though, it still may force you to do the FTE calculation and the salary reduction calculation in a way, at least offline, because that's maybe the only way you'll be certain that you can check one of these boxes. I guess with the exception of the first box, you're gonna know if you're self-employed with no employees, you're good to go. But otherwise, if you've had FTE cuts or salary cuts and restored them, you're gonna have to go through the exercise to make sure that you can rely upon the safe harbor. So maybe it'll save you some work, maybe not. Fiscal year entities and the tax deduction. This has come up here. There's quite a few of our clients that have June 30th fiscal years for tax reporting purposes. And the question is this: we know, according to the IRS, PPP expenditures are not tax deductible. And the reason why, according to the IRS, is, well, the loan's forgivable, so therefore you shouldn't get a tax deduction. I think there's a lot of people out there that can make some pretty good arguments that the IRS is off base in this analysis, because Congress intended that the loan would not produce income when forgiven. So it seems like Congress intended a tax benefit, and the IRS seems to negate this tax benefit with this position. But completely aside from that, if you have a loan on the books and you've incurred a bunch of eligible expenditures, and then your tax year ends before your loan is forgiven, a lot of our June 30th fiscal year clients will have this happen because they won't be able to apply for forgiveness. Couldn't you take a position that the expenses are still tax deductible, even though the IRS said, well, you can't take a tax deduction because they're forgiven? And your position would be that, well, when I closed my tax year, the loan was still due and outstanding. It was real debt. It's a real note. It's accruing interest, has not been forgiven. So could I take a tax deduction? The answer is maybe. And then the next question is, well, what do you do in the next year when the loan is forgiven, partially or fully? What do you do? Do you recapture those previous deductions? Do you have income? Who knows? And maybe practically speaking, if this is you, best advice may be to file an extension and just hope Congress fixes the issue in the meantime. Congress could weigh in and just say it's deductible, end of story. But this has come up more than a few times with a few clients. I wanted to put it out there that if anyone's facing a similar position. Maybe Michael, I'll turn it to you for the application timeline.
Yeah, so, once we get to the point to where applications, we do have the ability to submit those as borrowers. The timeline of how that's going to work is a lender has up to 60 days upon the receipt of a complete application to issue a decision for forgiveness to the SBA. Now, I will say there is kind of a caveat there with the complete application. Potentially a lender could accept maybe an application and a signed certification and not consider that a complete application. That would then maybe allow a borrower to calculate those FTE and salary forgiveness calculations, but wouldn't start the clock for the bank's 60-day timeline until they receive the supporting documentation. Just kind of a thought there on how you could maybe work around the potential time difference between the application submission and the completion of the covered period. So again, the lender has 60 days to issue that decision to the SBA. The SBA will then review the information, and they have up to 90 days to submit their decision back to the lender. Upon their decision, the appropriate forgiveness amount will be submitted to the lender plus the interest through the date of the payment to the lender. So the borrower will not have any interest due on their loan either. If there are EIDL advance amounts, these are the grants or the grants that were offered through the EIDL program. The SBA will specifically deduct those amounts from the forgiveness amount that's remitted to the lender. So if the SBA determines during their course of review that the borrower was ineligible for the PPP loan based on, the provisions of the CARES Act, the guidance, the interim final rules, the terms of the borrower's PPP loan application, or if there's inadequate basis for making the certifications for the PPP loan, the loan may not be eligible for forgiveness. And if that's the case, the lender will be responsible for notifying the borrower that there is no forgiveness or the forgiveness amount at that point in time. So if only a portion of the loan is forgiven for whatever reason, or the forgiveness is denied, any remaining balance on the loan must be repaid by the borrower on or before the maturity date. Now, one thing to point out with the PPP Flexibility Act, the maturity date of the loans was extended to 5 years for any loans issued or originated June 5th or later. If your loan was originated prior to June 5th, that maturity date is 2 years, but it can be negotiated with your lender for up to 5 years. So the lender is responsible for notifying the borrower of the remittance by the SBA for the forgiveness amount. And if if the forgiveness is not in full, the lender will need to notify the borrower of when their first payment is due. In general, the loan forgiveness process, that's described is only applicable to those loans that are not selected for review by the SBA prior to the lender's decision. So for instance, maybe there's some irregularities and the SBA selects a loan to be reviewed. They will let the borrower and lender know that has been that loan has been selected, and then that kind of throws this whole kind of timeline out the window, and there is a time for where the SBA will require additional information from the borrower if their loan is subject to review. So finally, there has been some information that's been released publicly. There's been the disclosure of borrowers' information with loans over 150,000. It's important to understand this from this aspect of, if you have a larger loan, you could be approached by a media source or outlet or by service providers. So be prepared for, those inquiries and have your ducks in a row from that standpoint. As it's noted here, have a clear message of need with the supporting documentation for why you took the PPP loan, why it was important, or obviously this is all being documented through your certifications. So just making sure that you're prepared for any questions that might come up in regard to that. Anything further on that, Adam?
No, let's get to the last PPP question here, or sorry, polling question here. We're just about to run out of time.
Sure. So last polling question. Media in your area have published articles highlighting prominent local businesses that have received PPP loans. True or false?
All right, that poll is open. It will remain open while we continue on.
So just to Amy, if I can get to the last slide.
Yep.
So we're at the end of our time here. Just quickly, the program was extended again until August 8th for new borrowers. There's still money available. There may be a second round of legislation, but it'll likely be more targeted if it comes out. It'll likely try to hit businesses that have had a specific gross revenue reduction. For instance, businesses that can demonstrate that they've had a 50% reduction in gross revenue, they may be eligible for a second round of PPP loans. We'll see that right now, this question came up, I saw a few times, there is no automatic forgiveness right now for any loan amount. You could have a $10,000 loan, there's no automatic forgiveness. The $2 million figure, if it's over 2 million, you're subject to a mandatory review by the SBA. That's the significance of $2 million. Under 2 million, it's not automatic forgiveness, it's just there's no automatic review by the SBA. There has been talk, maybe Congress will say every loan under $150,000 is automatically forgiven. That would make sense, but we don't have that rule at this point. So I guess I'd just say with that, thank you everyone. We're even a minute late, but thank you for attending and stay tuned. We'll have, like I said at the beginning, we'll have additional articles and insights as this program continues to evolve, and we'll probably certainly have another webinar at some point once we have enough material here to cover an hour. So with that, I hope everyone has a good weekend, stay safe, and we will talk to you soon.